Okay, it's 2 minutes after 7, so good evening, everybody. We'd like to welcome you to the SCORE Cleveland first of the two sessions workshops we have on financial basics. And there'll be three of us actually two presenters. Richard will be the host and watching things, but Richard and Richard Brooks and Chris Anna Lazar and I were part of a team some time ago, and we were asked to put together a course on finance and accounting, but without being about textbook accounting, but to talk instead about the principles of accounting, how businesses can use that data for their own benefit, how the data is derived in a very general way without going into all the details of accounting, and then how that can be used for businesses to increase their profits and make their processes healthy. So that's what we're going to be talking about. But first, we'd like to talk a little bit about SCORE. SCORE is a national nonprofit organization that is dedicated to small businesses. And it started in around 1964, not too long after the time when President Kennedy challenged us to ask what we could do for our countries. Same time that the Peace Corps started and Vista, shortly thereafter, SCORE started to help small business. Next slide, please. Like any organization, we have a mission and vision, and it is, as you can see on the slide, very much focused on fostering vibrant small businesses and to help people, whether they're in business or they're just thinking about it, to get the support they need to be able to thrive as a small business owner, to know what the process is all about, what it entails. So the services we provide, the biggest one, the one we spend the most time on, is mentoring. And before the pandemic, that was mostly face-to-face. Now, of course, we use remote methods. Even though things have quieted down on that front, we found that our clients and we are doing pretty well by doing it remote. So we serve as a sounding board. We listen to your plans, listen to your ideas, and walk through ideas and show you resources that might help you to achieve your goals. And we keep meeting as often as you like. And as long as you like, to help you at every step. Just find out where you are in the process, what obstacles, what achievements do you have, and what look like some of the likely next steps to get to your goals. But we also do workshops and seminars such as this one, and we do a whole host of others. We have a service where our mentors can serve on the board of advisors for a business. So if the business wants to put together a board of people to be kind of another set of eyes on the business health, we're available for that. One other thing that's not on this slide, our website, score.org, is a wonderful treasure trove of resources for small business. So if you go to score.org and you go to business education, and under that, there's something called templates and additional resources. And you'll find everything that used to be in something called the SCORE library. So just a host of articles and blogs and templates to do just about anything you want to do. Next slide, please. And our services are free because our infrastructure is paid for by a grant from the U.S. Small Business Administration, as well as money from a few sponsors. We jointly sometimes undertake creating resources with businesses and other organizations. And because most of us in SCORE, 10,000 plus people, are unpaid volunteers. So because of all that, we are absolutely free to you. We don't have to make a profit or money. We're here for you. We're people who want to get back to our communities. And so we're glad to do this. Next slide, please. This is the website for SCORE Cleveland. And this is Cleveland homepage. It has, much like score.org, it has the same resources, has links to the national SCORE resources. In addition, it has a lot of resources particular to Northwest or Northeast Ohio. So you can find various articles and resources that are actually pegged to starting certain kinds of businesses in this area. There were also, Cleveland has been a very dynamic organization. We were chapter of the year last year nationally. And we're continuing. We work with a lot of organizations in the area, a lot of neighborhood associations, economic development organizations. We partner with many of them. And we're sponsoring a networking event on the 12th of September. Uh, that's uh, um, that's going to be, it's on the website. Uh, so Cleveland Connects is what it's called. And it's a chance to meet with other business people as well as many of the SCORE mentors and really network and get to know other people in the business environment. Networking is key to success in a business. Be refreshments served. So if you get a chance, we'd love to see you there. Next slide, please. Okay, I'm going to turn it over to Chris Anna now, and she's going to give some of the slides, and then I'll be back to give some additional ones toward the end. So Chris, it's over to you.
Thanks so much, John. So we are going to be talking about how to make more money in your business, and we're going to be approaching it from learning the basics of financial vocabulary, using that vocabulary to figure out how to calculate profitability. And once we know profitability, we're going to use that to calculate your break-even analysis. I'll explain what all that means very soon. Then we're going to move into the types of accounting that you can receive, a few different financial statements, and we're going to wrap it up with financial service providers, different categories and what they're called and what they cost and all that fun stuff. So we're going to get started with just some really basic vocabulary. We're going to be tracking all the money that's coming into your business and all the money that's going out of your business. We refer to the money coming into your business as revenue, and the money that goes out is the expenses of your business. And if we subtract all of your expenses from all of your revenue, we're left with your profits. So just to repeat, your sales, it's not 100%. You could have money coming in from interest-bearing accounts and things like that. For the most part, money coming into your business is going to be through sales, and money going out of your business is we're going to be calling expenses. So we're going to track all the money coming in, and we're going to want to track all the money going out. Now, tracking numbers, invoices, accounting, it really only matters if it's going to help you make business decisions. So we're going to look at how is this going to help you make business decisions. So if we start with expenses, there's two categories of expenses. We have fixed expenses and we have something called variable expenses. Our fixed expenses are kind of like what it sounds like. They're fixed, they're the same every single month. So they don't change from month to month, regardless if your sales go up and down, these expenses are the same month to month. Your variable expenses are directly related to the amount that you're selling, whether it's a service, whether it's a product, doesn't matter. These expenses to your business go up as you sell more and they go down as you sell less, usually. Some examples of your fixed expenses would be things like your utilities, your auto loan, rent, insurance, loans that you have for equipment, and salaries that you paid salaried employees. There's a different category of employee of direct labor or hourly labor. That's going to be part of your variable expenses. So again, these are the things as you sell more, you generally have more expenses. These are things like commissions, your marketing, certainly your raw materials, shipping charges, and like I said, your direct labor associated with what you're selling or your hourly labor, generally not your salaried employees. So we're going to look at a made-up company called Puzzle Mania. So we're going to cover a service business, and this is a manufacturing business. We're going to start with looking at their fixed expenses, the expenses that are the same every month. So in the example of Puzzle Mania, they have rent is $3,000 a month. They have a telephone bill that's $100 a month. Their insurance is $300. Salaries are $500. And their internet service, excuse me, is $120 a month. Need a water. Their utilities are $550 a month. So their total fixed expenses every month, whether they sell 100 puzzles or 1,000 or none, it's the same every month, $9,070. Excuse me. Their variable expenses are going to be expressed in a form of a percentage. Because again, as they sell more, this will be more money. Their raw materials are 15%, wages 20%, credit card fees 3%, their shipping is another 3%, and they spend a fair amount, 8%, on marketing. So their total variable expenses are 49% of what they're selling goes to their variable expenses. If Puzzle Mania sold 1,500 puzzles at $20 a puzzle in October, if we multiply 1,500 puzzles times 20, that'll give them revenue of $30,000 for the month. Now we want to see, well, what does that leave them in profit? So we're going to take 30,000, and to figure out what the 49% is, we take 30,000 and multiply it by 0.49. That'll tell us that our variable expenses are just under half, $14,700. We know already that our fixed expenses are $9,070. So if we subtract both our variable expenses and our fixed expenses, that leaves us with $6,230 of profit. So to see what profit margin that is, we divide 6,230 into our monthly sales of $30,000. That tells us we have a 21% profit margin based on sales of $30,000 a month. It's a very nice, healthy profit. Now, anytime you're bringing in a profit, don't forget this is really get some new businesses in trouble. Uncle Sam is your partner in your profitability of your business. So make sure as you are starting to realize more revenue and profits, make sure you put money to the side for the taxes that you're going to owe on that. We're now going to look at something called a break-even point. And the break-even point I love is really exactly what it sounds like. It's the sales level where your total revenue, all the money coming in, equals your total expenses, all the money coming out. You're not making money, you're not losing money, you're literally breaking even. To calculate your break-even point, we're going to want to take your fixed costs, the monthly fees the expenses that don't change, and we're going to divide it by something called a contribution margin. You calculate your contribution margin by taking your cost per unit and you subtract the variable cost of that unit. So you're going to divide your fixed costs by your contribution margin, and that's going to tell you how much you're going to need to sell. So let's go back to Puzzle Mania and see what their break-even point is. We know that their fixed expenses are $9,070 a month. We saw that on the other screen. We also know that their variable expenses are 49%. So we're going to start with their fixed costs, $9,070 a month, and we're going to divide it by the contribution margin. So again, to calculate that, we're going to take their unit price, which was $20 per puzzle. We're going to multiply $20 times 0.49. That's going to give us the cost, the variable cost of making that product. That comes out to $9.80. If we subtract $9.80 from the $20 sale price, we're left with a contribution margin of $10.20. So we're ultimately going to divide the fixed costs, $9,070. We're going to divide it by $10.20, 10.2, and that's going to tell us we need to sell 889 puzzles to break even. So again, we got that by taking our fixed costs, 9,070, dividing it by our contribution margin, 10.20, gave us 89 puzzles. Now, if we multiply 889 puzzles times $20, this is our break-even point that's expressed in dollars. So we need to sell $17,780 to break even for this manufacturing company that makes puzzles. If we sell exactly 889 puzzles, 17,780, we won't be making money and we won't be losing money. If we sell more than 889 puzzles, we're going to be profitable. If we sell less than 889 puzzles in any month, we're going to be losing money that month. So I'm going to go through the exact same scenario, but instead of a manufacturing company, we're now going to go into the service industry and we're going to look at Lulu's beauty salon. Lulu's has quite a bit of overhead. She's got rent of $4,600 a month. She's got a $300 telephone bill. Her insurance is $1,200. She has one salaried manager. She pays $3,750. Her internet IT website is $820 a month, and her utilities are about $750. So she's got $11,420 to pay right out of the gate. That's her fixed expenses that she owes every single month, regardless of her sales. Her expenses, you can see, are also on the high side. Her shampoo and conditioner is barely costs anything, 2%. Her hair dyes and perm kits are a little more, 7%. The bulk of her variable expenses in the form of commissions. She pays her stylists on commission. They get 45% of the revenue coming in for services. Credit card fees is going to take out 2%, and she pays about 4% for marketing. So all in total, her percentage for her variable expenses is 60%. So how much business does Lulu do on average? She generally services 18 clients a day, and she's open 6 days a week. So if we multiply 18 times 6 days a week, she does about 108 services per week. And there's 4.3 weeks in every month. And her average service costs $120. So we're going to multiply 108 services a week times 4.3 weeks in the month times $120 for the average cost of her service. And we're going to see that her revenue for the month is $55,728. So that's all the money that she has coming in. Now, profitability. We're going to take 55,728 and multiply it by 0.6. That's going to tell us that her variable expenses for that volume of revenue is $33,437. And we're also going to need to subtract her fixed expenses of $11,420. That's going to leave her with $10,871 of profit. Again, if we want to know the percentage of profit margin, we divide 10,871 by her total sales of $728. And that shows us she also has a very nice profit margin of 20%. Now we want to see, well, what's her break-even point? How much does she have to sell to be not making money and not losing money? So we're going to start with her fixed expenses, $11,420. And we know her variable expenses are 60%. So we're going to start with 11,420, and we're going to calculate her contribution margin. So again, to calculate the contribution margin, we're going to take her unit price, her average sale of $120. We're going to multiply that by 0.6, and that's going to tell us her variable cost, 60%, comes out to $72. If we subtract $72 from 120, we're left with $48. So $48 is her contribution margin based on a variable cost of 60% and an average price per unit of 120.
Chris, we have a question. Melissa is asking, how did you get the variable percentages?
So the variable percentages, we would have to, well, this is going to be hard to go back. You basically want to look at your volume of sales, and you want to look at the history of what your expenses are. So we're going to, at the end of all of this, we're going to look at how do we get all of this information. It's an excellent question. And I would say, when I'm through with these slides, we're going to talk through where do we collect this data from. You may be able to do it on your own, and you may want to, if you don't already have a SCORE mentor, you might want to sign up to have a SCORE mentor, because many of our mentors specialize in finance and accounting and are more than happy to help you get things organized and figure out where you are and how much you're spending relative to your revenue and relative to your other expenses. So the first step is collecting all of your information, dividing what's fixed and what's variable, and then calculating that based on the history of what you've been paying out, basically. But excellent question.
Thanks.
I hope everyone is thinking, how can I calculate that? That's the goal. So we're going to divide 14,000, I'm sorry, my numbers, I'm saying a lot of numbers, 11,420. We're going to divide that by our contribution margin of $48. So that tells us we need 238 clients per month for Lulu's to break even. Again, we took our fixed cost and we divided it by our contribution margin. And then it's expressed in two ways. It's expressed in how many clients do we need, or we can look at it and say, if we have 238 clients at an average sale price of $120, we see we need to sell $28,560 to cover all of our expenses. If we get to that, we're not making money, we're not losing money, we're at our break-even point. And every business should really know what's your break-even point, because you can set goals. If I don't sell X number of units, I'm losing money. You also know, after you hit your break-even point, your profitability is what remains of your sales minus your variable costs. So you are roughly in a 40% profit margin. If your variable costs are 60%, most of your sales after you meet your fixed expenses, that's where the magic happens. That's where you really start to make money, because you've covered all your fixed expenses. And now all you have to deal with are your variable expenses after that. If you sell more than $28,560 or 238 clients, you're going to be making money, you're going to have profits. And if you sell less than that, you're going to be losing money that month. So we have one more example, and hopefully after this third one, it'll really start to gel and make sense. And again, I hope everyone is asking themselves, what's my break-even point? How do I figure this out? Because this is really the way to set goals and know where you're making money. And if you're not making money, where your money's going. So our last example is Walter's Window Washing Company. This is a one-man band. He washes windows and he works out of his home. So his expenses are different than the other ones we've looked at. He has a truck lease that is $600 a month. His truck insurance is $150. His liability insurance is $400 a month. He pays his health insurance through his business, which is $1,250 a month. His cell phone is $100, and his website and internet is also $100. So his total fixed expenses per month are $2,600. His variable expenses are much different than the other businesses we've looked at. His biggest expense is gas at 10%. He uses cleaning products, of course, that's 4%. His rags and towels are 3%. Credit card fees are 3%, and he has a little bit of marketing, 4%. So his total variable expenses per month come to 24%. If Walter serviced 2 clients a day, 4 days a week, he would have 2 times 4 is 8 services a week times 4.3 weeks in the month. At an average service of $300, he'd be looking at $10,300 of revenue for the month. So when you think of something like a window washing company, there's a couple things to worry about. Number one, he can't wash windows in the rain. And number two, it's also a seasonal business. So if he's lucky, he might have 6, maybe 6.5, 7 months if the weather's really accommodating. So when you have a business like this, you're not just really looking at your monthly profitability. You have to really do some more intensive cash flow analysis to see how is he going to get through the winter months and how else is he going to generate revenue. But taking this just as through his summer months, we can calculate his profitability. We're going to take $10,320, and we're going to multiply that by 0.24. 0.24 is his percentage of variable expenses. That comes out to $2,477. So we're going to subtract both his variable expenses and his fixed expenses, just like the other companies. And his profits are $5,243, which is a very large profit margin because you see he works out of his home. He's limited his fixed expenses. His variable expenses is mostly his own labor and gas and a little bit in materials. So he is wildly profitable. If we divide 5,243 into his monthly sales of 10,320, he's got a 51% profit margin. But again, that's just part of the whole picture. We have to also look at what is he going to do in January, February, March. So now let's do the same calculations we did before for Walter's break-even point. We're going to start with his fixed expenses that we know are $2,600 a month. We're going to know his variable expenses because we calculated our 24%. We're going to divide his fixed cost by his contribution margin. So again, his average sale is $300. We're going to multiply that 300 by 0.24. That gives us $72 is his variable cost per service. If we subtract 72, his variable costs, from the sale price, the unit price, that gives us a contribution margin of $228. So we're going to take $2,600 and we're going to divide it by 228. That's going to tell us he needs 12 clients a month to break even. Again, we divided 2,600, his fixed costs, by his contribution margin. So his break-even point expressed in clients is 12 clients. And if we want to know the dollar amount, we take those 12 clients, we multiply it by his average service price of $300, and that gives us $3,600 is his break-even point. If he sells more than $3,600, he's profitable. If he sells less than $3,600, he's going to be losing money. So hopefully looking at these three examples in different types of businesses with different types of overhead, different fixed costs, different variable costs, gives you some idea of what you want to look for in your own businesses. So now we're going to get to the question of, well, how do I do this? How do I get this information? So one of the easiest ways is if you have an accounting software program, all of this information is in there. You might need help running reports. You might not know exactly how to get to it, but all of the information is in there, and certainly a SCORE mentor can help you with that. If you don't have an organized accounting software system, this is still something that you can absolutely do. So on the revenue, sales, money coming inside, you can look at your bank statements in your deposit section to figure out what your revenue looks like. If you have a point of sale system, that will have all of your revenue information. You might be the type of business that writes paper receipts. Maybe you sell through Square, Venmo, Cash App, Zelle, Shopify, and so on. So depending on how you record your sales is going to be how you're going to collect all the data on the revenue side. I'd say that's the easier side of the two, of revenue and expenses. On the expense side of things, you're also going to look at your bank statements, but you're going to look at the debit section. So if you're not completely on top of your accounting, your bank statement is really the best, I think, first place to start of where is your money going. So you may not know exactly, but you can go and itemize as you see your purchases. If it's a credit card bill, as an example, which I listed lower, within the credit card bill, you'll need to know how much gas are you paying? What category? Did you buy office expenses? Did you have contractors 1099 that you paid? So your bank statement has lots of information. More specifically, other areas to look are things like a checkbook, if anyone is still writing checks, paper invoices, vendor account histories. This is another area. If you have a handful of vendors that you use regularly and you have not kept your paperwork organized, you can very easily call your vendors and say, could I get a year-to-date report of all of my purchases for 2023? Or if you want to go back to 2022 and do calculations, you can ask your vendors, could I get a report of all of my purchases for 2022? I can't say all of your vendors will be able to do that easily, but I would imagine that most of them could probably get you that information pretty easily. You'll also want to look at your credit card bills. And again, you're not looking at the total bill. You're going to have to subdivide into categories all the purchases on your credit card bill and what category they go into. Employee payroll, and lastly, 1099 contractors. These are all of the places that you can go to collect this data and figure out, where are you spending money? What categories is it going into? This is how you're going to break it into, these are my fixed expenses and these are my variable expenses. And once you see your revenue and your variable expenses, we can help you, or you can calculate percentages based on different sales volumes. So I think that just about wraps up my portion of this presentation, and I'm going to pass it back, the baton, to John to continue with types of accounting.
Okay, thank you, Chris. Now that Chris has gone over the basic sources of financial data, how it's arranged, how it's categorized, and how it's basically calculated. Uh, we'd like to rather change our focus just a little bit and talk a little bit about how data is used, financial data is used. And there are two ways financial data can be used. We call it two types of accounting. Financial accounting it looks backwards, it records all the past transactions. Managerial accounting forecasts future performance. For going back to financial accounting, there are very strict formats, very strict conventions, and there are courses in accounting. We won't be going into all that, but it is very strict because you're actually creating a financial record that's used by a lot of people. Managerial accounting, on the other hand, is simpler, but it's got to be consistent with financial data because you can't forecast if you don't base it on history. So that's one of the differences. Financial accounting has to withstand an audit. And if you've ever had a tax audit or if you've ever been part of an organization that's been audited, that's very, very precise. However, the standard for managerial accounting is you're looking forward. You don't know what you're going to find. So it's got to be realistic. And realism is what people look for if you're showing people forecasts of future events. Financial data is usually done by an accountant or other provider, maybe software. If you don't have anything too complex. Managerial accounting is for the manager. So it's done by the business owner with support from the accountant and other provider. And those folks can do you some good. So that's what we're going to be talking about. Next slide, please. So basically what each type does for you, for financial accounting, you're mostly creating information for others. You use it yourself, but you're using it primarily, as we said in the last slide, accountants, bookkeepers, accounting software, all those things generate the data. And it's a lot of stakeholders want to see that. Potential investors, potential lenders, potential collaborators with your business. Those are the folks that want to see your past performance. Managerial accounting, though, this is the closest thing we've got to a working crystal ball. This is information for you. You might share it with some of your stakeholders, but it's primarily for you so you can plan. And what really managerial accounting does for you, it helps you to create a financial model of your company. And a financial model is just taking the data that Chris has described and recording it faithfully, and then considering what happened in the past and what you're expecting, what trends are in the industry, what you know about your own plans for your business, your own best guesses as to what you think your customers are going to want, what their tastes are going to be in the future, and you'll build a model and try to forecast out the future. And anybody who's just starting a business, forecasts always start out very, very rough because you've never been there. And so basically you're guessing. And there are fortunately a lot of sources of information, but it is necessarily rough. And one of the things we always talk about how we shouldn't assume things, but when you're starting out in a business and you're trying to forecast the future, you have to assume certain things. You can kind of assume, get a pretty good idea of your costs. You know what things are going to cost. What you don't know, and you know what your prices are going to be, but you don't necessarily know how many people are going to buy your product or service. So your sales figures, your revenue figures, especially at the very beginning, are very, very rough. But as you get experience, you get some history, and you project forward, you take that history, and then you mix in your own judgment, your own view of what you're seeing, whatever opportunities or threats are in the environment, what you're seeing going on in the industry as a whole, and it gets better as you go along. Never perfect. Nothing, no kind of forecast of the future ever is, and so that's basically what it is. And you can use, certainly if you've got a financial product or you've got an accountant, you've got accounting software. Those systems come with pretty much what you need to do that. And each of those systems you can learn and do that. However, even if you don't have an accountant or an accounting system, you can use spreadsheets, and from spreadsheets, most spreadsheet programs have graph programs, or you can make the data visual. Also, even if you don't have computer access, you can make a table, a matrix, in the graph paper and do the same thing. It's more labor intensive, but you can lay out these things, and we'll show you some rough tables of data in the next session. We're going to be practicing. They'll be very grossly oversimplified, but it can be reduced down to fairly simple products. So even for businesses that don't necessarily have computer access or access to a spreadsheet program, and there are very expensive spreadsheet programs, but there are also some out there that are free. So those things are getting to be less of an obstacle. But you can do this yourself with or without the help. It's always better if you can get the software or the help, but there are ways to do it. So for the rest of the session today, we're going to focus mostly on managerial accounting, the accounting you do for yourself. Next slide, Chris. So there are 3 standard statements. There are lots of others, a lot of other kinds of financial products, but there are 3 basic ones. One is profit and loss, and Chris has basically described the elements of a profit and loss statement, or sometimes called an income statement. Cash flow is another way. We'll be talking about that in a minute, how it also uses money in and money out, but it displays it differently for a different purpose. We'll be talking about that later. There's a third basic financial statement. Our team chose not to address this, but it's basically called a balance sheet. And if you've ever done a net worth study of your own household, where you put your assets on one side and your liabilities on the other, it's similar to that. The only difference for a business, you have the assets on one side, you have liabilities, and then you have a third category under your liabilities, which is equity. It's what the business owes the owner. And always with business balance sheets, they're always going to come out evenly. And the bigger the equity, the more your business is worth to you. So that's basically what a balance sheet is. We're not going to be doing any examples on that, but they're just basically, a balance sheet is just a snapshot of what your business looks like in terms of assets and liability. That's really all it is. And certainly there are plenty of pure accounting classes will get much more on that. So basically, these 3 basic statements help you to prepare your taxes, which is one of those traditional accounting tasks that everybody has to do. Looking into the past, but it's necessary. The profit and loss statement helps you to do that. You can produce information that potential lenders and investors request, both historical data and they often ask for projections. So both traditional accounting, managerial accounting can be used for that purpose, and also help you as a manager to predict the future of your business by creating the financial model we talked about. We're going to talk a little more, and especially in the next session, we're going to practice it, how you can use the data to gauge the health of your business, some of your business processes, what processes are going well, what ones are going poorly, and what products or services can be made more profitable. And next slide, please. So the profit and loss or income statement, as Chris said, you're taking revenues and expenses, money in and money out, and you're looking at your current profitability. That's financial accounting. This is where you're looking at data that you've already booked. You've recorded your transactions. You can see what your profitability is right now. You can also use it as managerial accounting to use as a crystal ball. How profitable might your business be over time? So look at your profitability in the past. The more past data, the more accurate it's going to be. But you also got to factor in business trends, things in your particular business environment, events you're seeing coming up on your plans for your business, and you make your best guess you can using assumptions, and that's entirely appropriate in this use. But you are looking into the future, and there's no precise way to do that. Certainly taxes, as we said, and you're demonstrating the fact that you've got a profit and loss statement. You're demonstrating to potential stakeholders that you've got, if you're not profitable starting out, you've got a path, a realistic path to profitability. And again, stakeholders like to see past data. They like to see realistic forecasts. And again, the standard realism. So that's part of that. Also, you can diagnose, and we'll talk a little about that, but more in the next session, excessive costs, maybe unprofitable product line. You might need to adjust your prices. You might want to adjust your service or product offerings. And you can use your profit and loss statement to do that. Okay, next slide. The next of the three reports, the second of the one we're going to talk to is a cash flow statement. It also takes money in and money out, but it displays it very differently. This is basically how you get a view of your cash resources. So essentially, what you're doing is you're taking the data, but instead of displaying it in a traditional accounting way for a profit and loss statement, you're displaying the data in a way that simulates what you think your checkbook's going to look like in the future. So if you go out and buy a big piece of capital equipment, you buy a truck or something like that, in a profit and loss statement, you're going to show that cost as an expense, and if you've borrowed money, you've got revenue to pay for it, then that's going to go down. In a cash flow statement, you purchase that truck, you finance it, you'll show the down payment in your cash flow. Then you'll be showing the monthly payments on it, expenses. So it's going to simulate what your checkbook's going to look like in the future. So if you've got a cash flow model, you can predict with reasonable amount of accuracy what your checkbook will look like in the months ahead. And with that knowledge, you can plan when to make major purchases, and you can also get not by itself, but with other information, you can kind of predict how large a cash reserve you'll need. And businesses need to have something of a reserve for lean times, and we're going to show some exercises next time of why that's important. But especially in times of high inflation and relatively low interest, you don't want to have such large reserves if your money's sitting there not doing anything for you, but getting a very small amount of interest. So you want to right size your cash reserve, and cash flow statements help you to do that. Next slide, please. There are various financial service providers that can help you, and like three levels basically. Bookkeepers usually have an associate degree or higher, and they record the financial transactions. So they're involved pretty much in looking into the past in the financial accounting. But that's what they do. They might also have insights. Might be individuals who are bookkeepers might be able to give you insight into your business and advice, but that's not what they're being paid to do. If you want advice on your business, you want to get an actual accountant, has a bachelor's degree or higher, because they can not only post transactions, they can interpret the financial information and actually give you business advice. And if your accountant's not doing that for you, then you might want to look and see if you can find one that does that charges a reasonable amount of money. Now, there's a higher level of accountant, and that's a certified public accountant. That's an accountant got all the same credentials, but they've also passed a professional examination. They're licensed and regulated by states. So if you really need a CPA, certified public accountant, they're another level of provider. In addition, there are all kinds of providers for individual services, their payroll services, and their tax services, and all kinds of specialized things. But basically, these are folks that you can use in your business. Some people use software, and in the beginning stages, that might be good, and some software might give you some insights. But these are the types of human beings that really can help. Next slide, please. So projections and ongoing accounting. It needs to be, you don't just do it once and make a forecast of the future, because it's like a weather forecast. The further out you go, the less accurate it's going to be. You need to do this on a continuing basis. And so as you're racking up financial data, you're also going to be making and clarifying your projections. It's like headlights in a car. The further you go ahead, the further you want to see. So you need to regularly have some continuity to do that. If you're using an accountant, and if they're not involved in your projections, you definitely want to sit down and talk with them, because you're paying the accountant to give you advice. So they can help you make better projections. They may be able to actually participate in that process. You as the owner, though, know all the factors you want to consider. So you're really in charge of projections. You can use the accountant to get a lot of advice on how to do it. If you're using software, software may give you some insights. If the software is giving you reports aren't squaring with your projections, you can call customer service, and I think it's about the best thing I can think of. Try to understand what's going on. They're not going to disclose their algorithms and their software, but they might help you to see how their system works, and maybe your projections. You just need to be adjusted so that it works with the mechanics of the software. So if you're not using an accountant or using the software, understand how those numbers are derived in the software, and that'll help you to make better projections. Hopefully the software is well enough constructed it'll serve you for projections, but if it's not looking right, if you can't seem to get it to add up, go ask somebody and try to understand that process better. And the next slide, please. So collaborating with your accountant is key if you have one, and if not, hopefully you grow to the point that you can actually hire one. One of the basic things in a business is something called a chart of accounts, and every industry has usually standardized charts of accounts somewhere well on the web, and you can find standardized. In order, a chart of account is just a list of buckets that all your expenses and all your revenues come in. And by setting those up, they're pretty much standard for the industry, but how deep you go, how finally you break those out, it's a matter of judgment. And so if you, we had some discussion earlier, I think Monica was talking about how do you get your percentages. Those percentages are based on your history, and again, tempered with your own guesses and insights into what's going on in your industry and in your particular business. And so as you do that, you eventually get a base that you can forecast. And so you can see that in our cases, Chris's examples showed a percentage for an average price for each unit of product or service. You could do that. You could break it down more finely. You've got several classes of products and services. You can come up with an average for each class of them. If you have just a few products or services, you can use actual data. But the more categories you have, the more work you got to do. And so you got to weigh the costs and benefits of how much you're going to break out your chart of accounts into individual pieces. But do regularly review your financial statements, your financial accounting statements and reports for any trends and anomalies. And then again, as you're projecting forward, look at those trends and see if how they need to be reflected in the future. And if the results are unexpected, that could be good or bad. Things could be worse than expected. You need to go certainly drill down into the data to see what's going on. Sometimes you'll find something went better than expected. That's also valuable because you might have something going on in one of your processes that you can export into your other processes, or make it, instead of being an occasional bit of good news, make it more regularized and more routine. So yeah, drilling down to find out what's behind good events is also worth doing. So you can use the data to identify, as we mentioned, your most profitable product or service lines and which ones maybe need a little help. Customer segments, we didn't talk about this specifically, but in addition to products and services, if you're selling to customers that can be sorted into several different groups, you may be selling some of your products or services to households and individuals, others to other businesses, business to business, maybe others online. And if those customers are enough different, you might be worth your while to divide up your data by customer segments so you can understand how to market each of those segments most effectively. So that's another way you can take your data and again, do a cost benefit analysis. It's got to cost you some money to break out the data more finely. What's the reward? And if it's worth it, it might be worth doing. Diagnosing any potential problem, quality problems, production problems, delays. You can use your data, financial data, along with your other data. It helps you to build a dashboard of your business and helps you to make your business more efficient, more effective, and better quality, as well as the financial data. So financial data sometimes will point to things that are going on in your non-financial processes. Okay, next slide. And finally, this is a glossary of the terms that Chris used earlier. It lays that out. That's for your use. And I forgot to mention at the beginning, the recording will be made available to you, as well as the slides. So you get links for those things. So you'll have all this information for yourself. And so this is a keeper for you. And then the next session, we're going to be taking these concepts. We're going to play with the data a little bit. We're going to come up with Puzzlemania and Lulu's. We're going to come up with some very simplified statements, and we're going to kind of walk through what those might look like. They're not going to look like real counting, but they're going to be structured kind of basically like that. We're going to look at the data, looking for insights into that. And the question I see on the board, I think the slides will be sent to email addresses you use when you register. I'm pretty sure that's how they do it on the class, the other workshops. Okay, Richard just confirmed that. Okay, good. Okay, but the next time we're going to actually look at some very basic, very roughed out data. It's not going to have all the fine points because it will be an eye test. If I put those slides out with all the accounting detail, you wouldn't be able to see it on slides. But we're very grossly oversimplified it just to get the ideas across. Some of the things you can do with the data. And then we're going to look at how you can use the data to make calculations. Is it advantageous to offer coupons or discounts? Is it advantageous to buy advertising? In ways you can actually use your data to make those kind of decisions. Because data should be able to help support your decision-making process. And then what happens if bad things happen? How might you adapt to various kinds of disasters? So we're going to talk about that, and then we're going to open it up and ask everybody to has any thoughts on how any things that they're doing that they'd like to share with the group, or any questions they have. So at this point, let's open it up to any other questions we have from this group for this week.
If anybody's interested or has a question, by all means, just go ahead and unmute and ask the question.
Yeah, and I didn't, Monica's question about a reliable source where we can find the average variable and fixed expenses. If you're just starting a business, if you're part of an industry association, you can, you may be able to get some of that information there. Looking at some of your competitors, you may not know their expenses, but sometimes looking at the price structure, you might get some ideas. But yeah, when you're starting out, it's mostly a guess. It's an educated guess, but it really is. You kind of know what your expenses are going to be if you know your processes, but sales is the real big question mark. So I hope that answered it. It really is a guess starting out.
If I can add on top of that, John, some trade associations do collect that information on a neutral basis. You know, they don't identify individual companies, and they make that data available within their trade association membership. Another resource is Risk Management Association. Risk Management Association is a nonprofit that goes out and surveys virtually every business type of business around the country. And they get unidentified information. Again, it's very neutral and no company is identified. And then they take industry averages for that business. And so they then divide the data into small businesses, medium-sized businesses, and large businesses. And if you haven't started your business yet and are looking for data points on fixed expenses and variable expenses, Risk Management Association is a very good place to start. Now, I will caution you that if you go to rma.org or rma.com, I don't remember exactly which one it is, in order to get that data for your business, they're going to charge you about $1,000. Our suggestion is find out which of your local libraries has a business library section, and normally the business libraries fund Risk Management Association, have subscriptions to Risk Management Association, and you can use their library for free. I can tell you that the Cleveland Public Library, the main branch at 6th and Superior in downtown Cleveland, the 4th floor is their business library, and you can use RMA there. If you're using any of the Cleveland Public Library branches, they all tie to that main office, and you can use them. But there are other business libraries around our service area, the Porter Library out in Westlake, and several others. So that would be a very good starting point for you to go and use that, just to get certain benchmarks. And you can then compare your benchmarks against your actual performance once you get going to see, you know, am I doing better? Am I doing worse? And then be able to analyze from that point on. Keep in mind, these are ongoing businesses. And so there are some efficiencies in ongoing businesses that startups don't necessarily enjoy until they get about a year or two of operation.
Okay, we have
Okay. There's a question here. Where can I find information on how sales taxes are estimated and when they are due? I need more information understanding sales tax procedures. Anybody want to handle that?
I actually I just went to the state of Ohio. In fact, I was going to put that in here. There's basically a let me find it here. Yeah, that's the one on variable expenses, but the one on it's on the chat side. Yeah, Melissa had asked about that. Basically,
Yes.
the state of Ohio. I will put this in right now. Just do it to everyone. Okay. Okay. All right. The state of Ohio has a booklet on starting a business in Ohio that goes into great detail on sales taxes, the various ways, the increments you pay it in, and all the mechanics of that are in there. So that's a good one.
Yeah, and your accountant can help you with that as well.
Yeah. Okay.
Any other questions? Okay, well, our next session is 2 weeks from today at 7 o'clock, and we're going to start digging down into more strategies and tactics to improve your revenue and to improve your profitability. And in the meantime, if there are any questions, that's what SCORE is here for. And hopefully some of you will request a mentor, and we'll be able to help you on an ongoing basis.
Thank you,
forward-
everyone, for attending.
Yeah, look forward to seeing you all in 2 weeks.
Take care.
Have a good night.
Bye.